Okay, welcome to JK Shah classes. Today we are going to revise for CA final direct tax chapter called Special Provision for Stock Market Dealing. There is no separate chapter in the act like stock market dealing or special provision for stock market dealing. It's just that in this chapter we are going to cover two sections, section 112A and section 111A. Special long-term capital gain and special short-term capital gain. Gain arising from transfer of three assets. Which three assets? Equity shares of a company, only equity shares, units of equity oriented fund or units of business trust. If it is a long-term capital gain, then section 112A will be applicable. If it is short-term capital gain, then section 111A will be applicable. If section 112A applies, when will 112A apply? For equity shares, if the period of holding, naturally equity shares have to be listed, then only securities transaction tax is possible. These two special rates sections are applicable only if there is STT paid, securities transaction tax paid. Period of holding should be more than 12 months for equity shares, and for units of equity oriented fund also period of holding should be more than 12 months in order to be called as long term. But for units of business trust, the period of holding should be more than 24 months. Okay. For long-term capital gain exceeding 1.25 lakhs will be taxed at 10%. Till last year, the threshold limit was 1 lakh, which is increased to 1.25 lakh. As we discussed in the preceding chapter rate of tax, here if you recollect, I told you that the limit is enhanced from 1 lakh to 1,25,000 from the beginning of the year. Only tax rates have been changed from 23rd July 24. Instead of 10%, rate will be 12.5%. Rate is increased. Same way for short-term capital gain, where there is no threshold limit, rate was 15% increased to 20% with effect from 23rd July 2024. Long-term capital gain will be taxed at 12.5 or 10% without claiming four types of benefit. Number one, without claiming indexation. Indexation is called as benefit available under second proviso to section 48. Next is without claiming benefit of first proviso to section 48. What is first proviso? First proviso means calculating capital gain in foreign currency instead of Indian rupees and then reconverting back the final answer, reconverting it into Indian rupees. Reconverting into Indian rupees, there will be some benefit available similar to indexation. This benefit also not to be claimed. And without claiming chapter 6A deductions and without claiming rebate under section 87A. We discussed in the preceding chapter in the previous video that rebate under 87A is allowed only to resident individuals against any kind of tax except of tax calculated under 112A. On the other hand, instead of long-term capital gain, if it is short-term capital gain, then it will be taxed at 15% rate if transferred up to 22nd July 24. Or will be taxed at 20% rate if transferred on or after 23rd July 24 without chapter 6A. Here only one restriction. For 112A, 4 restrictions, 4 benefits will not be allowed. For 111A, short term capital gain, 1 benefit will not be allowed. So let's start with section 112A. Gain arising if it is long term from transfer of equity shares of a company, units of equity oriented fund or units of business trust, and STT has been paid, then it will be taxed at this lower rate. It will be taxed at 10% or 12.5%, but first 1.25 lakh will not be taxed. However, the benefit is available subject to compromising with 4 benefits. Indexation not allowed, first proviso to section 48 not allowed, chapter 6A not allowed, and rebate under 87A not allowed. On the other hand, one more benefit available, first 1.25 lakhs will not be taxed. Exceeding will be taxed at 10% if transferred up to 22nd July or 12.5% if transferred on or after 23rd July. Subject to following conditions. Condition number 1, which is unimportant, transfer takes place on or after 1st April 2018. Prior to 1st April 2018, long-term capital gains were exempt under 1038 section, now taxable from 1st April 18. And second condition, STT should have been paid. As far as securities transaction tax is concerned, out of the 3 assets, for the last 2 assets, equity oriented units or units of business trust, STT should be at the time of transfer only. STT on transfer only. Whether STT is there at the time of acquisition or not makes no difference. But as far as first asset, equity shares are concerned, STT is required at both the points of time. STT should be there at the time of transfer also and at the time of acquisition also. So, if the long term asset is equity shares, then STT should have been there both at the time of acquisition as well as at the time of transfer. But for other two assets, STT need not be there at the time of acquisition, STT has to be there at the time of transfer. Which two assets, equity oriented units or units of business trust, STT should have been paid at the time of transfer. So in other words, if you can understand, as far as equity shares are concerned, STT is required at the time of transfer for sure. At the time of acquisition also, STT has to be there. As far as unit equity oriented funds or units of business trust are concerned, STT has to be there at the time of transfer. At the time of acquisition, it may or may not be there. Not required. If it is there, well and good, but not required. Simply, if you want to take a screenshot, simple language, for equity shares of a company, STT has to be there at both the points of time, at the time of acquisition also, at the time of transfer also, subject to some exceptions. Wherever STT not possible at the time of acquisition, like if shares are acquired under bonus, if acquired by way of bonus, then STT would not be there. Bonus, right shares, or acquired under IPO or follow-on offer, FPO, etc. Okay, and this STT condition is not applicable in case if the shares are transferred or any of the asset is transferred through a recognized stock exchange located in International Financial Service Center and the entire sale consideration is in foreign currency. Transfer takes place on a recognized stock exchange located in an IFSC and the consideration is entirely in foreign currency. Then 112A subsection 3, STT need not be there neither at the time of acquisition nor at the time of transfer, meaning thereby whenever the dealing is through recognized stock exchange in IFSC, STT condition will not apply. Without STT having been paid, benefit of 112A will be available. 112A subsection 4, that STT at the time of acquisition, which is a prerequisite condition, need not be there in case if shares are acquired under IPO, FPO, that is follow on offer, bonus issue, right issue, or acquired by non-residents in accordance with foreign direct investment policy of government or any other transaction as may be notified. So without STT also 112A available. 112A is for all assessee, individual, HUF, AOP, BOI, company, partnership firm, LLP, resident, non-resident, ROR, RNR, everyone, irrespective of residential status. And also if it is long-term capital gain, then it will be subject to grandfathering of cost of acquisition. Grandfathering of cost of acquisition, grandfather means previous provision which is deleted. In our case it was exemption under section 10 clause 38. 1038 is deleted, replaced by 112A. 1038 is a grandfather, that is old provision. 112A is a father, that means the current provision which is already introduced. And what do you mean by son or grandson? Son means future provision which is not yet introduced. So father and grandfather. Grandfathering means previous proceeding or previous provision which is deleted, then also applying the same as of today also, that is called as grandfathering. This is applicable only with regards to long-term capital gain and provided long-term capital asset was acquired on or before 31st January 2018. If acquired on or after 31st January 18, then this concept does not apply. Okay, so what to do in that case? Then cost of acquisition will be higher of the following two. Cost of acquisition will be either actual cost or FMV as on 31st January 18. But FMV as on 31st January 18 should not be more than the actual sale consideration received or accruing now. Meaning thereby, first you do lower of the FMV as on 31st January 18 and the actual sale consideration. Out of these two, find out whichever is lower. Lower of the two that you compare with actual cost, and whichever is higher will be your final cost of acquisition, and then capital gain will have to be calculated accordingly. Let's try to understand with the help of some example. So the cost of acquisition under grandfathering, first of all, grandfathering is only for long-term capital asset. not for 111A, not for short term capital asset. Secondly, it is for all the three assets: equity shares of a company, units of equity oriented fund, units of business trust, provided they are acquired on or before 31st January 18. If acquired on or after 1st February 18, then grandfathering concept does not apply. Section number is section 55, subsection 2, clause AC. What to do? So answer, higher of the following two is to be taken as the cost, ignoring the actual cost. However, second point is lower of two things: FMV as on 31st January 18 and the actual sale consideration now. So first what you should do, first of all you should finish off with the second point, find out whichever is lower, this or this, whichever is lower, and once you are done with finding the lower, then you compare with actual cost of acquisition, whichever is higher will be your final cost of acquisition. And then in the second half of the page we will be computing capital gain, long term capital gain. Long term capital gain means sale consideration minus cost of acquisition, indexation not allowed. Cost of acquisition will be subjected to grandfathering if acquired on or before 31st January 18. Let's try to understand with the help of few examples. For example, example number 1, 2 and 3. Suppose any cost of acquisition is 100 lakhs, 100, 100, 100 in all the three examples. Cost of acquisition is 100 lakh, fair market value on 31st January 18. Before that, sale consideration. Cost is 100, 100, 100. Sale consideration is 190, 190, 190, 80 and 160. If this grandfathering of cost of acquisition would not have been there, then how much would have been taxable? Then in example number 1, 190 minus 100, the amount taxable, the capital gain would have been 190 minus 100. Capital gain would have been 90 lakhs. Second situation, sold for 80, acquired for 100. So 80 minus 100, sale consideration is 80, cost of acquisition 100, there would have been a loss of 20 lakh. And in the third example, acquired for 100, sold for 160. So 160 minus 100, the capital gain would have been 60. This is what would have happened if grandfathering of cost of acquisition concept was not there. Now what will happen because of grandfathering? So as I told you, first what you do is that finish off with the second point. The cost of acquisition will be higher of the following two, but before that find out lower of the following two. Lower of these two. Which one is lower? Answer 180. The FMV on 31st January 18. That figure you compare with 100. Whichever is higher. So answer 180. 180 becomes your cost of acquisition. Now because of this what will happen is, my cost of acquisition which was going to be 100 instead of, and my capital gain was going to be 90, instead of 100 my cost of acquisition will now be 180 and my capital gain will be only 10. Earlier it was 90 if you recollect that figure, now it will be 10, meaning thereby this is a beneficial concept. Second situation, second example, sale consideration is 80 but FMV on 31st January 18 was 180. First you find out whichever is lower. Which one is lower? 80. Lower of the two you compare with actual cost of acquisition, whichever is higher. So answer, cost of acquisition will be 100. And if cost of acquisition is 100, my capital gain without grandfathering was also negative 20. Now also it will be negative 20. This situation it will make no difference. Because of grandfathering here there won't be benefit. Third and the last example, sold for 160, FMV was 180, acquired for 100. So what do you do first? First you compare between FMV and the actual sale consideration. Out of these two, whichever is lower, lower of the two is 160. 160 you compare with 100, whichever is higher. So answer 160 will be my cost of acquisition. Earlier cost was going to be 100, now the cost will be 160. My capital gain will reduce by 60. So now what will happen is, sale consideration is 160, cost of acquisition which was 100 now will be 160. Accordingly, capital gain will be nil. There can be furthermore examples also, but this example will clarify your position. If you want to take a screenshot, kindly do the needful, or rather take a screenshot of next slide. Okay, Coming back here, what do you mean by FMV on 31st January 18? FMV on 31st January 18, if it is shares and they are listed, then you take stock market price, but in stock market we have highest price, lowest price and the average price. So what you do is that you take highest price. If it is units listed, then take highest price on the recognized stock exchange. If units are not listed, then you take NAV, net asset value. Highest price on the recognized stock exchange on 31st January 18. However, if there was no trading on 31st January 18, then you go backwards, go to 30th January. If there was a trading of this particular company script on 30th January, take the highest price on 30th January. If there was no trading on 30th January, go backwards to 29th January and so on. And units which are not listed, if anything which is listed, equity oriented units, units of business trust or equity shares, if listed then take highest price. Not listed, then for units you take NAV as on 31st January 2018. Short term capital gain. Long term is over. If it is short term capital gain, it will be taxed without indexation and without any grandfathering. Grandfathering of cost of acquisition is only for long term capital gain. Three same assets, equity shares of a company, units of equity oriented fund or units of business trust. If STT has been paid, then they will be taxed at 15% flat rate if transferred up to 22nd July 24 or at 20% flat rate if transferred on or after 23rd July 2024. Provided the sale transaction has suffered STT. Here STT needs to be there only at the time of sale, not at the time of acquisition. Neither for equity shares nor even for other assets, STT need not be there at the time of acquisition at all. STT has to be there at the time of only transfer. Okay. Except in a case where asset is sold through a recognized stock exchange located in IFSC. If it is located on IFSC and the entire sale consideration is in foreign currency, then without STT also benefit of 111A will be given. Okay. Then no deduction under chapter 6A. Here only one restriction. 112A 4 restriction. Benefit of second proviso to section 48, that is indexation not allowed. Benefit of first proviso to section 48 not allowed. Chapter 6A not allowed. Rebate under 87A not allowed. But for 111A only one restriction, chapter 6A not allowed. Provisions of 111A, 111A are applicable to all assessee, individual HUF, AOP, BOI, company, firm, LLP irrespective of residential status. Equity oriented unit means what? Equity oriented fund or units of equity oriented fund. So equity oriented fund means two situations, either a situation where there is only one fund, you have invested into this fund, you are Mr. A. This fund invests more than 65% of its available funds in equity shares of listed company. If there is only one fund involved, you are the unit holder, you are investing here and they are directly investing into stock market, not via any other fund, directly investing. They are investing more than 65% in equity shares of listed companies, then this fund will be equity oriented fund. However, second situation, here only one fund was there. Second situation where there are two funds available. You are Mr. A, you have invested in fund 1. Fund 1 is not making investment in stock market directly. Fund 1 is investing in fund 2 and then fund 2, that is mutual fund number 2, is investing in equity shares of listed company. Then in such situation, percentage condition is slightly different. If they directly invest in stock market, then they should have invested more than 65%. If they are investing through fund 2, then fund 1 should have invested more than 90% or equal to 90% into fund 2. And fund 2 should have invested 90% or more of its available funds with equity shares of listed company. In this situation, both of them invest 90 or more than 90 in stock market, then fund 1 will be called as equity oriented fund. And there is no fund 2, only one fund is there, then more than 65% should be invested in equity shares. Okay. Then rate of surcharge. Now normally for individual HUF, AOP, BOI and AJP, 5 people, whether resident or non-resident, surcharge rates we have 5 slabs: 0%, 10%, 15%, 25% and 37%. However, in the preceding chapter we discussed that 25 and 37% will not apply on these special incomes. There were 5 incomes on which surcharge rate will be capped at 15%. No surcharge beyond 15% on tax on 5 incomes. Out of 5 incomes, 2 of the incomes were covered by this chapter, 111A short term capital gain and 112A long term capital gain exceeding 1,25,000. So what will happen? As I said, surcharge rate shall not exceed 15% whether opting for new tax regime or the old tax regime. In such situation, if the income is up to 50 lakhs, then there is no issue. Then surcharge will be 0. If income is below or exactly 50 lakhs, then no surcharge. If income is more than 50 but up to 100 lakhs, including these incomes and including normal income, then also no problem. Surcharge rate is 10% only on tax on each and every income. When the income is more than 100 lakhs, more than 1 crore but up to 2 crore, including these special income, then also no problem. Surcharge rate is 15% and the capping is on 15, should not exceed 15. Up to 15 is fine. So till here there won't be any issue. Till the time the net income including these special incomes is 2 crore, no issue. The moment income exceeds 2 crore or 5 crore, where the surcharge rate of 25 and 37% is going to be attracted, here there will be difficulty. So here there is a clarification which we will discuss in the next chapter in detail. It says, excluding these 2 special incomes, if the income is more than 2 crore, income is more than 2 crore after excluding these 2 income, keep these 2 incomes aside. If the net income, meaning thereby normal income other than these 2 income itself is more than 2 crore, then on tax on that income, tax on that normal income will be subjected to 25% surcharge and tax on these 2 incomes will be restricted to 15%. And in case if the total income excluding these incomes exceed 5 crore, then where 37% should be attracted. But what do you mean by the income exceeds 5 crore excluding incomes covered by these 2 sections? That means normal income, other income itself is more than 5 crore. Other income itself is more than 5 crore. Then tax on other income will be subjected to 37% surcharge and tax on these 2 incomes will be subjected to surcharge at the rate of 15%. So here for these 2 points, see, up till now problem did not arise because income was well within 2 crore mark, where the surcharge itself was otherwise also not more than 15%. Problem will be when the income exceeds 2 crore. But if the income is exceeding 2 crore or 5 crore without these 2 special incomes, then surcharge rate on tax on other income will be 25 or 37%, and the tax on these 2 incomes will be subjected to surcharge at the rate of 15%. And last point, if the total income exceeds 2 crore including incomes referred to in these 2 sections, then and the case is not covered by point number 4 or 5, meaning thereby total income exceeds 2 crore because of these special incomes, meaning thereby normal income is below 2 crore, but after adding these 2 special incomes total income becomes 2 crore or exceeds, then surcharge rate will be 15% on tax on entire income, special income as well as normal income. This is not the right place to discuss this point because this concept is applicable to total 5 incomes. So this concept we will discuss in detail with many examples when we come to next chapter or next to next chapter, special rates of tax. Okay, so this paragraph we are not discussing. Now comparative analysis between section 112A and 111A. Out of these 2 sections there are 5 points of differences. Number 1, availability of threshold limit of 1.25 lakh. 1.25 lakh is available only for long term capital gain, deductible from the beginning of the current year. This facility not available for 111A. Grandfathering of cost of acquisition is also for 112A, not for 111A. Rebate under 87A is not allowed when the tax is computed under 112A LTCG. However, 87A rebate is allowable. Remember this, it is allowable when the tax is computed under 111A. Next point, chapter 6A deduction. Chapter 6A deduction point is common. Deduction not allowed against either of these 2 incomes. Why not allowed? Government says on one hand we are giving you lower tax rate, so on the other hand we will take away some benefit. And last, STT condition at the time of acquisition on equity shares, which is only for equity shares. This condition is relevant or applicable only for long term capital gain, not for short term capital gain. We have discussed everything. Last point, ULIP. Now capital gain chapter will discuss concept once again. Capital asset is defined in section 2 clause 14. Capital asset. Capital asset means property of any kind. So when Arun Jaitley ji became finance minister, he converted it into section 2 clause 14 subclause A, subclause B, subclause C. Subclause C, ULIP, if normally ULIP means unit linked insurance policy. After all, it is insurance policy. Being insurance policy, it should have been eligible for exemption under 1010D. If it is not eligible for exemption, under section 1010D, then it will be taxable. But taxable under which head? So answer, if it is ULIP, then maturity proceeds will be considered under the capital gain chapter. If it is normal policy where the insurance premium exceeds 10%, 15% of the sum assured, for normal insurance policy, maturity proceeds will be under the IFOS. For ULIP, it will be taxable under the capital gain, but indexation not allowed. However, all these things will happen. The definition of capital asset now cover ULIP also, but only if it is a high premium ULIP, not eligible for exemption under 1010D. When will it not be eligible for exemption? Answer, as per 4th and 5th proviso to section 1010D, if 3 conditions are satisfied, then ULIP maturity proceeds will be not eligible for exemption, will be taxable. Which 3 conditions? Number 1, ULIP is issued on or after 1st February 2021. It is not 1st April, it is 1st February, the date of announcement of budget. And secondly, annual premium of such ULIP exceeds rupees 2,50,000. And then the third condition, policy matures otherwise by way of death. Maturity of the policy, that is ULIP, maturity is otherwise by way of death. Otherwise than by way of death of the policyholder. Meaning thereby, policyholder dies, then even if first 2 conditions are satisfied, it's a high premium ULIP, then also exemption will continue if there is a loss of human life. But the person does not die, he is alive and the policy matures due to completion of tenure, then it will be taxable. Taxable under this head. This is what is clarified by section 2 clause 14 subclause C. However, amendments are carried out in section 112A and section 111A, that in case if it is long term capital gain arising on transfer of ULIP or it is short term capital gain arising on transfer of ULIP, then STT will be there, securities transaction tax, that is always there. The benefit of these 2 sections will be available. LTCG exceeding 1.25 lakh will be taxed at 12.5 or 10% depending on the date of transfer. And here also, without any threshold limit, 111A, it will be taxed at 20% or 15% earlier up to 22nd July. However, the benefit is available here only for 3 assets. Now ULIP is not one of the 3 assets. Which 3 assets is the benefit available? These 2 sections are applicable on 3 assets: equity shares of a company, units of equity oriented fund, units of business trust. Now apart from that, has government introduced one more asset, ULIP? Answer, no. ULIP is not separately introduced. ULIP will be considered as part of second thing. Which is the second thing? Second asset, units of equity oriented fund. ULIP will be considered as, what is the full form of ULIP? Unit linked insurance plan. ULIP units will be considered as equity oriented units, provided the insurance company which issued ULIP or the mutual fund which issued you ULIP should invest more than 65% of the available funds in the listed shares of or equity shares of listed company all throughout the tenure. First of all, 3 conditions fulfilled, then ULIP is taxable. ULIP is issued on or after 1st February 21, annual premium exceeds 2,50,000 and ULIP matures otherwise by way of death of the policyholder. If there is a death, exemption will continue. So corresponding amendments made in the capital gain chapter, section 2 clause 14 subclause C, ULIP will be capital asset. 45 subsection 1B, charging section of capital gain chapter, describes how to calculate capital gain in case of ULIP. So it says very simply, whatever is received minus whatever premiums were paid up till now, irrespective of whether ATC deduction was allowed while paying premium or not. Amount received minus amount paid to the insurance company by way of premium. Whatever premiums are paid up till now. Say I paid 12 lakh rupees every year per annum into 7 years I paid 84 lakh I have paid, ignoring indexation and ignoring any inflation in the country. Sale consideration received by me is 96 lakhs. Then in that case 12 lakh will be my LTCG. This LTCG should be normal LTCG covered by section 112. If it is treated as normal LTCG under section 112, then rate will be 12.5% without indexation. Rate would be this. And in case it is considered as special LTCG covered by section 112A, then tax rate will be 12.5%, but on the amount of LTCG exceeding 1,25,000. So which one is beneficial? Both are equally beneficial. The rate of tax are same only in both of them, plus surcharge plus health and education side. The only benefit here is this: first 1.25 lakh is not taxable, right? Okay. So there is a clarification that it will be considered as part of 112A or 111A. Benefit of 112A, 111A will be available provided the mutual fund invest more than 65% of its available funds in the listed shares. Second, 45(1)(b) clarifies the procedure, and last, CBDT issued circular and clarified further that benefit of 111A and 112A will be available on maturity proceeds of ULIP also. ULIP will be considered as a capital asset. In upcoming chapter, we will discuss if there is a maturity proceeds of regular policy, regular life insurance policy, then maturity proceeds either will be exempt or taxable. If taxable, then taxable under IFOs. But if it is unit linked insurance policy, then ULIP insurance policy will be taxable under the head capital gain. Under the head capital gain, it may be taxed as short term or long term, depending upon period of holding. It could be, if it is long term, benefit of 112A may be available and may be taxed at 12.5% on the amount exceeding 1.25 lakhs. Otherwise, what will happen? Otherwise, it will be covered by 112. Normal long term capital gain will be taxed at 12.5%. If it is short term capital gain, then either 111A will be applicable or no 111A. 111A applies, then will be taxed at either 15% if transferred up to 22nd July 24, or taxable at 20% if transferred on or after 23rd July 2024. And if 111A does not apply, then it will be taxed as per normal rate as applicable to the assessee. That's it. With that, this chapter comes to an end. See you in the next video with the next chapter.